Friday's closing bell. It didn't just end the week. It drew a massive question mark right on the weekly chart.
A big one.
We're looking at a weekly candle on the S&P 500 that, technicians call a neutral spinning top.
Which is really just the market's polite technical way of saying we have absolutely no idea what happens next.
Exactly. It's sitting right there at 52-week highs, just teasing a breakout. But if you were active on the desk Friday, hoping for a clean rip or a sharp rejection, you got neither.
No resolution at all. The bulls just couldn't get the momentum for a breakout, and the bears, they couldn't force any kind of liquidation.
A total stalemate.
It is a stalemate, but let's be clear about what kind of stalemate this is. This isn't a relaxed, gone fishing kind of market. It's compressed,
Coiled.
tightly coiled. It's waiting for permission to move. And since it's Sunday morning, January 25th, 2026, and we are staring down the barrel of a huge data week, that hesitation makes perfect sense.
It does. But before we get into the week ahead, I want to stick with this stalemate idea for a second. There was one data point from Friday that I can't shake.
The volume.
The volume. We drifted higher into the close, technically painting the tape green, but it happened on 15% lower volume than the week before. That feels artificial.
That is the textbook definition of a retail-driven float. I mean, think about who's trading on a low-volume Friday afternoon right before a Fed week.
It's not the big pension funds.
No, it isn't the sovereign wealth desks rebalancing. When you see price drift up while volume falls off a cliff like that, it tells you the smart money, the institutional heavyweights, they're just sitting on their hands.
So the car is moving forward, the speedometer's ticking up, but nobody's actually stepping on the gas.
Exactly. They are waiting for a real catalyst to break this range, and until they get it, we are just floating on retail fumes. It's dangerous to mistake that for genuine conviction.
Okay, so let's get into the technical damage report, because even though we're at highs, you've flagged some cracks in the pavement. Starting with the S&P 500, you're watching a critical convergence at the 6,180 pivot. Why that number?
So 6,180 is where the 10-week exponential moving average meets the previous breakout point. In plain English, this is the line in the sand for the medium-term trend.
It's the institutional trailing stop.
It is. As long as we hold above that, the broader uptrend is fine. You can shrug off the daily noise.
But the risk is if we lose it.
The risk is completely asymmetric. If we close below 6,180, you de-risk the entire soft landing trade. Algos that buy dips, they shut off. And the ones that sell weakness, the CTAs, the trend followers, they wake up.
And it opens up a trapdoor.
A big one. Straight down toward 5,900. It's a fast move. You don't want to be standing on it when it opens.
And that's just the S&P. The NASDAQ 100, which has been leading this whole charge, it looked even more precarious to me. We saw a yellow flag on the close.
We did. It finished 12 points below the 20-week trend line.
Now, 12 points sounds like a rounding error on an index over 20,000. Is that just noise?
In a vacuum? Maybe. But technical analysis is about psychology. A break is a break. That trend line has been the backbone of this tech rally for months. Every single time we touched it, buyers showed up. This time, they didn't.
It signals fatigue.
AI fatigue, exactly. It tells us that the muscle memory of buy tech at any price is getting exhausted.
And there's a hard valuation pivot on the NDX at 21,250.
Right, that's the value area high for the last quarter. Think of that as the price range where 70% of the trading happened. If we go below 21,250, we're leaving that comfort zone.
And the market enters a valuation reset.
Immediately. The whole playbook flips. You stop buying dips and you start selling the rips because the structure is broken.
The volume confirms that shift too. I was looking at the internals. Red days outweighed green days 2-to-1 last week.
That is institutional distribution, plain and simple. We are seeing large funds trimming their magnificent exposure, pulling back on the big tech names, and rotating into defensive cyclicals. They're not dumping everything, but they are absolutely lightening the load.
Which brings us to the elephant in the room, the U.S. 10-year yield. It's just trapped in this wedge between 4.10% and 4.45%.
The macro anchor. Everything in equities, every PE ratio, it's all priced relative to this number.
You said there's only one number that matters for the next 48 hours.
Yeah.
4.35%. Why that level?
Because that is the technical ceiling. It's the key resistance. If yields clear 4.35%, the entire algorithm for the market changes.
The risk-free rate goes up, so risky assets have to come down.
They have to compensate. If we break 4.35%, SPX 6000 becomes an immediate magnet. The equity market simply cannot sustain these valuations if the 10-year breaks out here.
Okay, so let's zoom out. We've got stocks drifting up on low volume, bonds coiled like a spring. What's the narrative driving all this? Because it feels like we've moved past Buy AI, ask questions later.
That story is definitely changing. The narrative has shifted from AI hype to what I'd call execution risk. For the last, 18 months, the market was trading on vibes, on the promise of what AI could do.
Future dreams.
Exactly. Now, in 2026, we're in the delivery phase. The market is no longer paying for potential. It's trading on actual margins and forward guidance.
So the phase of easy valuation expansion is over.
It has completely stalled. Earnings growth has to do all the heavy lifting now. If these companies can't prove that all the money they poured into data centers is turning into immediate cash flow, the multiples will compress fast.
You describe the institutional positioning right now as reluctant momentum. Unpack that for us.
It's a fascinating divergence. If you look at the CFTC data, you see the big hedge funds, they're net long gold and WTI crude at 23-week highs. So you have to ask yourself, why are you buying gold and oil at highs?
It's a hedge. Against inflation, geopolitical risk. It's a bunker trade.
It's a bunker trade, but at the exact same time, look at the industrial metals.
Dr. Copper.
Yes, copper and silver. Net longs there are falling. Copper is the best proxy we have for global growth. When copper sells off while gold rallies, it tells you the big desks are hedging for a global growth slowdown that isn't on the tape yet.
So they're buying fear assets and selling growth assets.
That's a huge red flag. It's the market saying, I'm staying long stocks because I have to, but I'm buying insurance like crazy because I don't trust this rally at all.
And the breadth backs that up. Fewer than 40% of S&P stocks are making new 20-day highs.
It is dangerously narrow. I mean, the whole rally is being carried by the Magnificent Seven plus NVIDIA. The soldiers are not following the generals. The structure is fragile. It's like a skyscraper built on a toothpick.
However, there's a counter-argument here. The pain trade.
The scenario that ruins the consensus.
Let's look at the VIX. It spiked 30% this month, sitting at 19. It's pretty high for a market at all-time highs. It means everyone is hedging for a black swan.
Right. Everyone is mod up on protection, they're long volatility, they've bought put options because they see the same cracks that we do.
So what happens if the bad thing just doesn't happen?
That's the squeeze. If the news is just okay, not even great, just not a disaster, all those hedges have to be unwound. When you sell a put to close your position, dealers have to buy stock to stay neutral.
And that creates a violent melt-up.
A violent melt-up. We could see a move through 7,000 just to liquidate those nervous shorts. It would force a massive FOMO rally right into early February. It's the trade that hurts the most people.
Okay, so that's the setup. Now let's walk through the minefield. The calendar is packed with red folder events.
This is the gauntlet. This week determines if the rally resumes or if it reverses.
It starts Wednesday, FOMC. The market has a hold priced at 94%, so the rate decision itself is kind of a non-event.
Correct. The entire game Wednesday is the dot plot, where the Fed members see future rates and Powell's tone about a spring easing cycle.
So let's game this out. If we get a hawkish hold, what's the tell?
Sticky inflation talk, higher for longer. Maybe they even remove a projected cut from the plot. Yields will surge and the dollar will rip.
And the sector to watch there?
Regional banks, ticker KRE. They're the canary in the coal mine for credit tightening. If Powell sounds hawkish, KRE gets hit first and hardest.
But if he's dovish, if he hints that they're worried about the economy.
If he acknowledges growth risks, then small caps, the IWM, they go to the moon. The soft landing trade is back on in a big way.
Then Thursday, we get the report card, Q4 advanced GDP.
The definitive read on the holiday season. Did the consumer show up?
There's a binary risk here. A hot number, say over 2.5%, is actually bad for the market. Explain the good is bad logic.
If the economy is too strong, it gives the Fed permission to stay restrictive. It kills the hope for rate cuts. So, good economic news leads to a bad market reaction.
And a cold number, under 1.2%.
Then bad is bad. Recession fears replace inflation fears. You'll see a sharp rotation into defensives, utilities, staples.
And the sector to watch is consumer discretionary, XLY.
Absolutely. A miss on GDP confirms the consumer has tapped out. If XLY breaks down, the whole growth narrative for the S&P 500 is in jeopardy.
Finally, Friday, the Fed's North Star, Core PCE.
This is the only number Powell really cares about.
So if it's hot, over 0.3% month over month.
Volatility. Total volatility. Equities sell off hard into the weekend.
And if it's cool, less than 0.1%.
Gold and tech rally. Hard. The sector to watch is technology, XLK, or QQQ. High growth valuations depend entirely on the trajectory of the terminal rate, and this print sets that tone.
Okay, so knowing all that, what's the game plan for Monday morning? How should traders be positioned?
The theme is the growth tug-of-war. Volatility is underpriced. You should expect a breakout from this tight range by Wednesday afternoon.
And you've identified the most exposed sector as real estate, XLRE. Why?
It has the highest sensitivity to what we call duration risk.
Right, how much the price drops when interest rates go up.
Exactly. REITs are incredibly sensitive. Their whole business model is leverage. If yields break 4.5% on a hot GDP print, their cost of capital becomes unsustainable. They get crushed.
But conversely,
Conversely, if there's any hint of a Fed pivot, XLRE becomes the highest alpha play on the board. It's been beaten down so much that any relief sends it flying.
and for rotation, where are we trimming?
Look at energy, materials, and transportation. They're technically overbought. They've had a good run. It's probably time to take some chips off the table there.
And where are we looking to buy?
Financials. Relative to the broader market, they are oversold. And here's the kicker. They actually benefit if the Fed confirms higher for longer.
Because of their net interest margin.
Precisely. Their margins expand, so they act as a nice hedge against a hawkish Powell. It's a defensive way to stay long.
So let's wrap this. The bottom line is the market is in a show-me state.
It is. The bulls have to hold SPX 6,180. That's non-negotiable. But more importantly, we need to see institutional volume return to confirm this trend. We can't keep floating up on fumes.
And the bear case.
It's all about the NASDAQ. If the NDX fails to reclaim that 20-week trend line, it could drag everything into a liquidity trap where buyers just vanish. That's when corrections turn into routes.
One final check on the levels.
Watch the 10-year yield, 4.35%. Put an alert on your screen right now. It is the only number that matters for the next 48 hours. If that breaks, nothing else is going to work.
So tighten your stops. Wednesday is the pivot. And don't chase any noise on Tuesday. It is very likely to be a head fake.
The bell is ringing. Stay sharp.